Anybody want to buy some noodles? Hello and welcome to The Week in Restaurants, a look at the biggest stories of the week in the restaurant business. I'm Jonathan Mays, Editor-in-Chief of Restaurant Business, and I am here with Senior Technology Editor Joe Guszkowski. Noodles Company is on the market. We will talk about that chain and its disappointing life as a public company. Smokey Bones is closing more restaurants. We'll talk about that situation. Later on Tech Check, Joe talks about AI. You might have heard about AI. But first, Joe, have you heard of McDonald's?
I have.
All right. So you might have heard, there might have been some story or 500 of them in our publication about extra value meal strategy. They are bringing back extra value meals. They are lowering prices on those extra value meals by essentially they are going to start giving customers a 15% or more break on the price of a burger, fries, and a drink if you buy all three. That's up from about 10% on average now. Really, to the consumer, that's going to be an average of about 15% cut in price. They are starting off next week with a introductory offer of an $8 Big Mac value meal and a $5 sausage McMuffin with egg value meal in the morning, which, Joe, there's two things going on here. Number one, this is a dramatic escalation of the value wars in the fast food business. I don't think there's any question about it. I think this is exactly what, this is exactly what's going on. It's going to be interesting to see if any of the company's competitors respond, which I assume we'll find out more on Monday, and maybe they won't. But the other thing is I tend to think this is a response to what's going on in the casual dining sector, where you see chains like Chili's getting real traction with the U.S. consumer by offering, prices at $10.99 or $9.99 or 2 for $25, whatever you want to call it. It's kind of a response to that. There are definite risks for this for McDonald's, certainly for their franchisees. But it really is, we're going to be spending the next several months talking about more intense value offers in the restaurant space. I don't think that there's any question about that.
Yeah, we've talked about this quite a bit. And my question on this, I guess, is how much of this is perception versus reality when it comes to McDonald's prices? Because when I go to McDonald's and, it's in the rotation, we go, maybe once a month, I feel like it's a good deal. And I don't get the value meals, so that might be part of it. But I feel like it's a much better value than Taco Bell, which has been doing far better than McDonald's as of late. So is McDonald's just bearing the brunt of this because they have been known as a value leader? They've been known for their dollar menu, their extra value meals historically. And so they are having to kind of take these increasingly extreme measures to kind of prove that?
I think a lot of it is perception. McDonald's is on par with their competitors in terms of price, and they have been. They are on par with Burger King. They are on par with Jack in the Box. They are on par with Wendy's. And, if you look at their base prices, and this is going to get them cheaper. On the value meals, this is going to get their value meals cheaper. I think a lot of what's going on here is that the U.S. consumer thinks McDonald's needs to be cheap and that it should be the cheapest option. It's not the cheapest option. It isn't. But it is competitive. It is absolutely competitive in pretty much all of its markets. The company has a really good pricing consultant that works with franchisees. And so they're really good on the pricing front, but they're not the cheapest. And a lot of that, the fact that they're not the cheapest, really goes to the fact that years ago, after they got away from their dollar menu, they began to realize that their convenience, and they're really, really convenient, is worth something to the U.S. consumer, that they didn't have to be the cheapest option anymore, that they could be maybe more competitive and on a pricing front, a little bit more equivalent to some of these other chains because they are so convenient. The problem is that I think the U.S. consumer has been dealing with an intense level of inflation over the past. I mean, inflation has eased, but really still the prices that consumers are paying today for all sorts of everyday goods, and not everyday goods like rent, are considerably higher than they were in 2019. And for the lower and middle income consumer, things are tighter. And that's been tough. And they've been, and then all of this has been sort of intensified by this social media environment in which kind of facts can be fuzzy or thrown out the window altogether. And so you end up having situations where somebody spots an $18 value meal at a Connecticut rest stop and throws it up on social media, and it becomes fact. Or there's some like random study that is no basis in fact that says that their prices have doubled in the past few years, which wasn't even remotely true. And all of that really hit a fever pitch. And then those pieces, that information, those social media posts, combined with consumer frustration over inflation. And by the way, I think that the fast food price situation is in reality just a proxy for consumer frustration over prices, period. In fact, I would bet a lot of money, if you could ever find this out, I would bet a lot of money that fast food prices on their own were maybe the single biggest factor in the presidential election last year. Because I think that consumers were really, really frustrated by prices. They saw prices at fast food chains that they think should be cheaper rising so much. And that told them that prices are just skyrocketing. That's what I think is what happened. And so McDonald's is sort of the focal point for that concern. And I think this is their response to that. That's what I think is going on. No, I completely agree with you. There's no way, for instance, that Chili's is not cheaper than McDonald's. And on any planet is it cheaper than McDonald's. And when you go to Chili's, and I love Chili's, trust me, I am as big a fan of Chili's as anybody. It is not cheaper than McDonald's.
It shouldn't be. It shouldn't be.
No, nor should it be. You're still getting a higher quality experience when you go to Chili's versus McDonald's. That is exactly what should happen. But you can, you go to McDonald's and you can cobble together, even without their $5 value meal that they've had on the menu for a long time, even without some of their discounts, you can eat pretty cheap. It's more perception than reality, I think. But I mean, their prices have gone up. I mean, in fairness, their prices have gone up somewhere in the neighborhood of 40% since 2019. And they've gone up because prices have gone up.
And everyone goes to McDonald's, so everyone feels that.
They do. It is yes, everybody does go to McDonald's. It is the rare person that actually does not. Joe, what happened with Smokey Bones? What's going on over there?
Smokey Bones closing more locations. They closed about 9 earlier this year, closing another 15. It's going to bring them to about 40 locations, I believe. And Smokey Bones was acquired by Fat Brands a few years ago. It's now been lumped together with Twin Peaks and spun off. Twin Peaks has been converting some Smokey Bones into Twin Peaks locations, and now has decided that it needs to close some Smokey Bones that aren't doing well to sort of just for the overall health of that company. It's a bit sad. Smokey Bones was created by Darden Restaurants, had over 100 locations at one point, and just hasn't worked. I mean, it's a full-service barbecue chain, just tough to do. There aren't really that many success stories in that segment. But I think it, maybe raises some questions about this whole Twin Peaks strategy, putting these two brands together. Neither have done well since going public. We'll see if those remaining locations can survive But yeah, not a real, great start for Twin Peaks over there as a public company.
No, not whatsoever. But it's also, keep in mind, one of the things about Twin Peaks is it's a controlled public company. It's kind of a double controlled public company because it's controlled by Fat Brands, which itself is controlled by the Wiederhorn family. So you're automatically just putting your stock at a disadvantage by doing that, because you can't get institutional dollars, whatever. I mean, look, Smokey Bones, God love it. Number one, your first sign that this chain is an issue is the fact that Darden got rid of it. I don't know. Darden doesn't get, I don't know. I can't remember the number outside of Smokey Bones and Red Lobster. And if anybody listening knows, because I can't remember, they do not sell restaurant concepts very often.
Bahama Breeze is
so Bahama Breeze is going to be the note. Yeah, that's going to be the next one. So it doesn't happen very often. So if Darden's getting rid of it, if Darden can't get things to a certain degree, that's a problem. And then you mentioned the fact that it's a barbecue concept. I mean,
strike two.
Yeah, that is big strike two. And then the other one, the third strike, by the way, Joe, is that Fat Brands looked at this and said, this would be better off being something else. Most of these locations would be better off being something else. They bought it as a conversion opportunity. Essentially means that Smokey Bones is and has been really now for a while, and this is just accelerating it. It's just on this is on a decline. I mean, it is a classic zombie concept. Its real estate is better off for something else. It's a barbecue chain, and consumers. If I'm going to a barbecue restaurant, I don't want to go to a chain. I'm sorry, I just don't. Actually, if I want barbecue, most of the time I'll just make it myself. However, I want to go somewhere where I don't want to go to a chain. I just don't. And I think a lot of consumers are like that. And I don't think consumers eat it that much. It really is a certain special occasion. So it's not every day enough. And that's always been the challenge for them. And then you always also have other issues. Joe, here's a little barbecue knowledge for you. If you want to make yourself, say, ribs, you want to make ribs and you really want to do it as a barbecue concept versus something like Chili's. You want to make them like a barbecue concept. It's going to take you hours. It takes me 5 hours to make my ribs. I could probably make them a little bit quicker than that if I turn up the temperature and wrap them and stuff like that. And I'm sure that, but even in the best scenarios, it still takes a long time to cook as opposed to, say, a steak or a burger or something like that, or fried fish, whatever. So it's always been a tough business. It's difficult to measure. It makes it very difficult to do on a chain-wide basis. To me, maybe you just convert all these convert the restaurants you can, and then just do something with the concept, period. And then focus on Twin Peaks, because if your Twin Peaks is starting to have challenges, then the main concept is challenged itself. And then you've got to fix that, because Smokey Bones isn't your future. You've basically said it. So focus on Twin Peaks and deal with it.
Yeah. It's got to be tough to be in that holding pattern as a Smokey Bones operator. But speaking of, you mentioned zombie concepts. Is Noodles in danger of going the zombie route?
Oh, Noodles is a zombie concept already. I can't let my wife hear that. Noodles, I think, is their favorite chain.
Wow.
Let me tell you a few things. Let me drop some knowledge on you.
Grab my notebook.
Yeah, let me drop some knowledge. Their units in the past, they went public in 2013. Their first day trading, their stock jumped, I think, 130% in that neighborhood. Well over. By comparison, Chipotle's doubled on the first day. And Noodles.
What was going on in 2013?
I believe if you just look at that first day pop, they had the biggest first day headline number that we've ever seen. Since then, their sales have gone up like 29%. Their unit volumes have grown an average of 1% a year. They've added about 0.5% unit count every year since then. They've franchised, so they franchise a lot more, but they've got 92 franchise units versus 371 non-franchise units. The company financially has been a significant issue. The company has been they've had to get rescue financing from L. Catterton and another firm that I'm blanking out on off the top of my head. They've had to get rescue financing, investment dollars. It just hasn't really done much. It's not really a zombie because it is technically still growing. But, I think, most of that growth has really, it is largely stagnant. It hasn't, it's just, and now it's thinking about going private. It's pretty much getting to zombie status at this particular point. Their stock price has been in the tank for the longest time. It's just one where you had a chain that got all of this publicity and got investors were just jumping all over that company when they first went public. And they've never been able to really live up to that. Their stock price, by the way, is at 70 cents right now. So their stock price is at 70 cents. They've lost 97.8% of their value since they went public. And it just never been able to really, they've had a succession of CEOs. They've tried well-known people. They've tried lesser-known people. They've had people who've had some real success at other companies. And nobody has been able to get it. At the end of the day, it's just noodles. And it's just noodles. They had some, it's always one of the more, always been one of the odder concepts that we've got. So, the big question is whether they'll actually be able to sell. And I would imagine somebody takes a bet on them, because it's not going to take you that much to do it. And if you can just figure something out, you can get the marketing right, or you find a product that just consumers just adore. Maybe you can do something. It should have gone private ages ago. Something should have happened ages ago to take these guys off the public market, because it's not, you can buy that thing probably for about $50 million plus debt. So and that's a long way down. It's tough. The restaurant business is difficult.
I'm curious what the hope was for that brand when it went public. But around that time, I liked noodles. They were good, but it's like the one bowl concept that hasn't really worked out. It doesn't have that health factor that I think some of the other fast casual concepts do, and maybe that's it. But
that's a big part of it. I just, noodle based concepts on a outside of like Italian full service chains, they've just never been able. If you think about Fazoli's and concepts like that, they've just never been able to take off. They've never really been able to do anything. And back then, if you go, I remember their IPO distinctly, and everybody was throwing money at anything that could be considered the next Chipotle. And they had some former Chipotle executives working for them at the time. And so everybody's like, oh, this is going to be the next Chipotle. This is going to be the next Chipotle. And then that's another problem. You get all of these restaurant chains that were going public at the time, and then they had to live up to this almost impossible set of expectations. Chipotle is a once in a generation brand, and it has very distinct advantages that no other restaurant chain can have. And it's not easily replicable, replaceable, copied, whatever word you can find for that. It's not easily copied. You can't really copy Chipotle very easily. And a lot of chains have tried. So, but it's tough. The business is tough, Joe. That's the conclusion for today.
Another week, another lesson.
All right, super. What do you got coming up on Tech Check?
Oh, we're talking about artificial intelligence. What else?
All right, super. Well, but before then, whatever advertisement Spoon sends us next, and it better be a good one.
Join Restaurant Business and Nation's Restaurant News alongside tech and AI expert Nikki Greenberg, along with executives from Dine Brands, Let Us Entertain You, Dave's Hot Chicken, and more at this year's FS Tech, taking place September 14th through 16th at the Gaylord Palms in Kissimmee, Florida. Learn more at informa.com/FSTEC.
Hello and welcome to Tech Check, where I, Joe Guszkowski, talk really fast about one big topic in restaurant tech. This week, a much-needed reality check for AI. So Taco Bell said last week that it's reconsidering how it uses AI in the drive-thru after it found the technology struggles in certain situations, like when restaurants are really busy. This came on the heels of an MIT study that's making the rounds, which found that 95% of companies using generative AI saw no return on their investment. These developments have taken a bit of the wind out of AI's sails, but I don't think that's necessarily a bad thing. The way we talk about AI has become so exaggerated that when it doesn't work, people act like the sky is falling. In reality, this is just part of the natural evolution of any technology. 2 steps forward, 1 step back. Taco Bell deserves credit for addressing the issue and taking a more nuanced approach. Rather than use AI around the clock, it's planning to coach operators on when and where it's most effective. Ultimately, that's what AI should be, a tool to help restaurants run better, not an all-or-nothing proposition. Hopefully, these developments can help us move past the hype and start focusing more on the reality.
And that should do it for the Week in Restaurants, which was edited, as always, by Spoons. Artwork by Nico Hines. You can find this and other episodes of the podcast on our website at restaurantbusinessonline.com. But by all means, subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays for Joe Guszkowski. Thank you for listening.